IT startups, an overview. IT startups are newly established companies that develop and deliver products or services related to information technology. These startups usually focus on areas like software development, mobile apps, cloud services, AI, or cybersecurity. IT startups often aim to create innovative solutions that meet market demands or solve specific problems using technology. The goal of many IT startups is rapid growth and scalability, which is often achieved by offering cutting-edge solutions. Startups usually operate in a dynamic environment, requiring them to quickly adapt to technological changes and market trends. Funding for IT startups. One of the most important aspects of launching and growing an IT startup is securing funding. Funding is the capital provided to startups to develop products, scale operations, or expand their market reach. There are various stages and types of funding, and understanding these concepts is crucial for any startup founder. Types of funding. Bootstrapping. Many startups begin with bootstrapping, where the founders use their own personal savings to fund the business. This method offers complete control but limits the company's growth potential, as resources are often constrained. Angel investors. Angel investors are individuals who provide early-stage capital in exchange for equity or convertible debt. They usually invest in startups that are in the very early stages but have promising growth potential. Angel investors not only provide funding, but often bring industry expertise and networks to the table. Venture capital VC. Venture capital firms are professional investment groups that invest larger amounts of money into startups. VCs typically come into play when startups have demonstrated market potential or have a minimum viable product (MVP). In exchange for funding, VC firms take an equity stake in the company and usually have a say in business decisions. VC funding is typically divided into stages. Seed funding, the initial funding to develop the MVP or further research. Series A, B, C, etc. As startups grow, they raise multiple rounds of funding to expand operations, enter new markets, or develop new products. Crowdfunding. Crowdfunding allows startups to raise smaller amounts of money from a large number of people, often through platforms like Kickstarter or Indiegogo. Crowdfunding can also serve as a marketing tool, allowing startups to gauge interest in their product or service before full-scale development. Equity and ownership. When a startup raises funding from angel investors, venture capitalists, or through crowdfunding, they often give up a portion of their equity in the company. Equity refers to ownership in the business. Giving up equity means that investors will own a portion of the company and share in its success, but it also means the founders may have less control over major decisions. For example, in return for a $1 million investment, an angel investor may require a 20% equity stake in the startup. This means the investor now owns 20% of the company and expects to see a return on that investment if the startup is successful. Real-life example. Airbnb. Airbnb is a famous example of a startup that raised significant funding to fuel its growth. Founded in 2008, the company initially bootstrapped by selling cereal to raise money for their platform. They later secured $600,000 in seed funding from investors like Y Combinator. Over time, Airbnb raised multiple rounds of venture capital, including a $112 million Series B round in 2011 and a $1.5 billion Series E round in 2015. This funding allowed Airbnb to expand globally and develop new services. Burn rate and runway. Two important financial metrics for IT startups are burn rate and runway. Burn rate, the rate at which a startup spends its cash. For example, if a startup is spending $100,000 per month, that is its burn rate. Runway, how long the startup can continue operating before it runs out of money. If the startup has $1 million in the bank and a burn rate of $100,000 per month, it has a 10-month runway. Both metrics help founders understand how much time they have before they need to raise more funding or become profitable. Exit strategies. Startups aim for either scalability or an exit strategy. The most common exit strategies include initial public offering, IPO. The startup becomes a publicly traded company by listing its shares on a stock exchange. Acquisition. A larger company buys the startup, often to gain access to its technology, talent, or market share. For example, Instagram was acquired by Facebook for $1 billion in 2012. Instagram had only about 13 employees at the time, but its rapid user growth and market potential made it a valuable acquisition. Challenges faced by IT startups. While the potential for growth is high, IT startups face several challenges. Market competition. Many IT startups compete in saturated markets, and differentiation becomes key to success. Technology risks. Developing new technologies often comes with technical challenges, such as bugs, scalability issues, or infrastructure problems. Talent acquisition. Finding and retaining skilled developers, data scientists, and engineers can be difficult, particularly for startups with limited resources. Scaling operations. As a startup grows, managing larger teams, more complex systems, and new markets requires significant operational adjustments. Real-life example, Uber. Uber started as a small IT startup in 2009, focusing on solving the problem of finding a taxi. It raised $200,000 in seed funding and continued to raise billions from venture capital firms to expand globally. Uber used its funding to develop the technology platform, build brand awareness, and deal with regulatory challenges. By 2019, Uber had its IPO and is now a multinational company operating in over 900 metropolitan areas worldwide. Conclusion. IT startups represent a vital segment of the global economy, driven by innovation, technology, and market opportunities. Funding plays a critical role in helping startups scale and grow, with different types of investors offering the capital and expertise needed at various stages. Despite challenges, startups like Airbnb, Uber, and Instagram show that with the right product, team, and funding, significant growth and success are possible.